Everyone, it's a pleasure to be here today, working from the home office on a Tuesday versus the other offices on Monday, Wednesday, Friday. I'm glad to be here. I wish I could be in Dallas as planned, but it's absolute pleasure to be part of Capital Factory and the Where's the Money keynote. My name is Seth Page, a little hairier and a little longer hair than we had 6 months ago, but I am an 8-time entrepreneur, 6 exits from those, and I have done many, many, many dozens of financings, both as an entrepreneur through multiple stages, angel investment, seed, A, B, C rounds, as well as IPOs and private placements as a banker, a private equity investor, and an angel investor. So hopefully I can give you some of the knowledge I know. Some of this will be basic for some folks and maybe new for the others. But today we're going to talk about industrial AI startups and where you can find funding, particularly venture capital, both inside and outside of Silicon Valley. And with that, I'll kick it off. What I'm going to do, just so folks know, is I'm going to talk about a recent funding round we did with an older deck, some sprinkled in and out, and a lot of stats on VC that'll hopefully help you. We're going to talk about how it really is navigating the AI space as a startup, both for pre-A and for Series A. What are the problems that people think you're solving versus the problems you're actually solving? How operations tech and information tech are light years away, and you're probably better placed in Texas and the Southern Belt and in the Midwest to capitalize on that. How most VCs actually lose money for their LPs. So we'll talk about a bit of the reality check of what people across the desk from you actually are doing. And of course, where the winning strategies are in AI and in industrial AI. As Trish said, double click on this screen, you can get the full screen. And if you can have any QA, you can put it in the chat window on the track sessions, which should be on your right-hand side. So to kick it off, right, we always start with a slide or two. You're going to have some sort of BHAG slide. If it's a B2C play, it's going to be much simpler than this. When you get into enterprise or AI, it tends to be a bit more content heavy. In our case, our BHAG was talking about the $25 trillion of waste that's endemic across the entire economy and is created by bottlenecks, right? So if you look at the $90 trillion global GDP, roughly 1/3 of that, 25%, is waste in all of its forms. And that's waste that can be managed. So in our case, our BHAG was, how do we help companies achieve and scale data-driven operations by managing bottlenecks with their own data and with our AI to focus on the 5 key pillars of stable operations, right? That's going to be, how do you make things faster, better, leaner, smoother, and safer? And that is, when you distill down the thousands of KPIs, it's really looking at things like cycle time, like defect rate, like inventory, like uptime, and like failures. That's the money side, right? That's the big goal, the BHAG. Folks often want to know what your mission is, right? Think of Google connecting all the information in the world, making it searchable, things like that. We talk about why throughput. Well, it's because these type of AI advancements cascade through the entire economy, the entire world, right? If you could make things leaner, better, faster, smoother, safer, you make your operations better. Your business, by definition, operates better and leaner. Your investors make more money, bigger dividends, bigger stock buybacks, better exits. Your communities are more engaged, workers have better full-time jobs, companies are reinvesting in capital equipment and their people in education. And of course, you have fewer inputs for the same amount of outputs coming out the other side, so it's better for society and the world. So this is where we talk about things like, we can make the world a better place, because you can save up to $25 trillion annually in the extreme long term, right? Once you kind of get over those buttons, you kind of come to where the rubber meets the road, right? You got a noble cause, you got a profitable cause, you've done this before, you got a great team. So you should be pretty easy funding. And people think that money grows on trees in Silicon Valley. And if you look at financings across the entire US, including Texas, Dallas, Fort Worth area, Q2 to Q1 has actually been relatively stable, right? The COVID effect didn't really hit. You've got a huge VC overhang, tons of money to deploy, but you will notice the number of companies has dropped slightly, which means that the rounds are getting bigger, which means the later stage rounds, the growth equity rounds, are coming in. And I'll have some slides on that later. If you look at the black slide on the right side there, but Dallas Fort Worth pulled in around $500 million in Q1. And Austin pulled in around the same 0.4, 0.5, if my glasses aren't lying to me. And in the latest for Q2, I just got on Austin, made the top 10 VC markets in the US again, pulling in another $400 million. So you're looking at Q1, Q2, about $1.5 to $2 billion of venture capital financing coming out of the main markets in Texas. You look at Silicon Valley, obviously, 800-pound gorilla pulls in about half of the VC for the whole country. And the US is still by and large the largest VC market in the world. Although China, India, and in Europe have grown immensely in the last 10 to 15 years as they have become their own markets. Low record interest rates have been the primary driver, right? Private, pensions, funds, sovereign wealth funds, family offices are chasing returns, so they have to invest in these alternative assets, which include venture capital, and of course, massive amounts of stimulus continues to pervade throughout the economy, trillions of dollars of new money, and folks are obviously then reinvesting that in VC. So this is an asset class that never goes away. It does go through big cycles. When the cycle ends, I couldn't tell you because we've been at a really frothy top for a number of years now, and the recent events have just only exacerbated that. The good news is corporations continue to seek startup innovation. CVCs, the corporate venture capitalists, are in there. They're looking for mergers. They're looking for innovation opportunities. So it comes into the old build versus buy versus buddy when you look at it. Do I do this myself? Do I buy the company, or do I partner with them? Right. And I think the big thing to watch out for is if you can get capital now, do it. Why? Because we've got this big problem out here called the economy that's disconnected from the markets, right? You've got the K-shaped recovery right now that hasn't turned into a V, a U, or a W. And so where the economy is going to be 1, 2, or 3 quarters from now, there's a lot of unknowns. It could be okay, it could be down, or it could be a wipeout. And VC will drop precipitously when there's a wipeout of the economy. If VCs pull back because they've got a 10-year horizon and they. So you turn around and you say, okay, we're looking at a company like ours, 6, 7, 8 months ago. It's costly, these bottlenecks are out there. Well, how much does it really cost me? Well, automotive companies can lose $60,000 a minute when a line goes down. Oil and gas companies can lose $7 million a week on a well when it goes down from a largely productive well. Airlines before COVID could lose up to $26 billion a year from flight delays and cancellations. After COVID, that's going to probably be closer to 75 to 100 billion, like a massive number. Manufacturing lines on average are 50K an hour when they're down. Lost locomotive time is $500 million a year, right? So you're talking some really big numbers. And we have one of the early stage people from Tesla who's part of our company. And even she launched all 3 of the cars, and even she noted that Elon's biggest problem was on the Model 3, their third car. Once they 1,000 per day, their real limiting factor, i.e., their bottleneck or their constraint, was how do we reduce our cycle time and increase our uptime so we can increase our output through the and out the door, right? So the reality is even the biggest minds and the third richest man in the world now have to deal with the economy of operations, which is where a lot of companies in Texas and the Midwest and the South thrive at, right? Take a look at AI, okay? AI and machine learning are somewhat synonymous if you know the technologies. They're basically the same thing along with data science. If you look at the VC exits by type, they've really exploded over the last 2 years, and they're this year going to probably continue to do so. This is Q1 data, so it's obviously very early. And if you look at the number of exits, it's the same type of curve, and you'll see this in every sector. Very much a Schumpeter curve, a build up and then a crash out over time as the market matures and there's fewer players. So AI in general is still good. Where there are returns to be had, you will see VC dollars flowing in for reasons we'll talk about. But this is the reality, right? Like we've already seen, if you look at Q2 here, it's the later stage mega rounds, the unicorn type rounds that still take over 50% of the funding. So they call the Series A, pardon the term, but they call it the A-hole round. It's the biggest hole you're going to have in your financing. It's the hardest one to get across because you're between a vision and an idea and an early stage MVP and an actual product that's predictably producing money quarter after quarter that just needs more fuel to grow. So what you typically see here is the dumb money and the late to the party money, right? People are getting in because of logos. So you see deals like Theranos and WeWork and Juicero and Ubiome and Munchery. raising hundreds of millions of dollars, and you sit there going, my gosh, my company can do so much more for society and so much more for investors and for companies. Why can't we get there? And that's because, these are low returns, but the growth equity guys, the later stage guys and gals who invest in that sector, they've de-risked the deal, right? They've already taken out the team risk. They've already taken out the model risk, the product risk. They're really just focused now on execution risk. And so they're willing to write very big checks later on. So that A round is the hardest round you're ever going to get. It's always been so. And you're also seeing later stage tightening up. So it was tightening up. It popped up again at the end of the day, but the rounds in general are getting smaller on a per unicorn deal. And folks are looking at alternative ways to get liquid, which we'll go through in a second. Last year, about 553 technology startups went bust, decimating $2 billion of capital. That's normal in any given year. If you look at Q1 this year alone, before COVID hit, we were already at 387. The latest numbers I'm getting from the number crunchers are that we can be somewhere between 1,200 and 2,000 technology companies decimated across the US this year. So obviously, like the rest of the economy goes, with restaurants and other small businesses, tech companies go too. A lot of companies won't get follow-on funding. They won't figure out their model. They won't understand their cost basis, and they'll be gone. And remember that most VCs, most partners who are partners now, and most founders have never been through a major downturn, right? This is generational, let alone 2 downturns or 3 downturns or 4 downturns in some of our cases, some of us older folks. So it's a brand new playbook for them. So some of us know what to do, how to rebuild the models, do sensitivity analysis, and change things quickly. Other people are flying by the seat of their pants and trying to figure it out. And you'll see kind of a natural flight to quality over time as you see the juxtaposition of those two groups. This is yet another one. What you'll see over 20 years is the amount of versus venture capital versus corporate investments. There's been a nice growth curve over time with some bumps in there, obviously. Non-traditional funding sources, non-VCs. So think of the Tiger funds of the world. The Prudentials, the sovereign wealth funds, the family offices have come further down the VC stack, and they're crunching out and they're squeezing VC, so it gets much more competitive for those later stage deals. And what that means is a lot of venture capitalists have become less early stage VC than they act, and they become later stage VC, right? Companies are staying private for longer. They require more capital. And few of them actually figure out their business model. And this is pre-COVID. So if you look at the 2019 numbers in their upper right corner, you'll see a bunch of flops, right? The Ubers, the Lyfts, the Pelotons, the Smile Directs, great companies, you'd think, but they actually traded in their IPOs at a lower cost per share than their final private round. So the last money in privately is losing money and is usually locked up for a good 6 months. Compare that to a few other companies like Zoom that was already profitable when it went public pre-pandemic and has, of course, exploded since then. And you've got a very, very different type of curve. So you see that kind of irrational exuberance in the IPO market, which is why you're seeing SPACs, right? Special purpose acquisition vehicles taking off, right? Last year, we had 59 for the whole year. In 2 months this year, for SPACs, we've already had 24. That's in 2 months. So that number is going to probably hit over 100. Some really big names in there. But as someone who's been on Wall Street, you see this every economic cycle. When you see a lot of SPACs or reverse mergers at the top, that usually means people are trying to find liquidity in ways that aren't always the most transparent. You've got perverse incentives, right? When you start seeing these mega funds, the $2 billion funds, the $4 billion funds, the $100 billion SoftBank funds, when you look at a 2 and 20, right, 2% yearly fee, 20% carry, that's extremely lucrative. And so you get the larger funds, whether they like it or not, start to go, and they start to focus on the 2%, right? They're optimizing for the wrong thing. Whereas earlier stage VCs will optimize for the 20, where they're going to make most of their money and get their LPs to reinvest in more and more funds. The more funds you have, the more 2 and 20s you have as a general partner, the richer you're going to get. So you have to understand how well your VCs are doing, how well their past funds have done, and what their economics incentives are. Remember, you're just a vehicle for them to get more money from LPs so that they can have a better life. They really aren't trying to change the world in many cases. Some are, many aren't. So just remember that you need to be aligned with the folks that you're going to take money from. And then, of course, collecting these big unicorn logos or decacorn or even centacorn logos has become very clubby here. So you look at angel investment, right? Angel investment's tiny in comparison to VCs, growth equity, PE, and IPOs. So what's a company do with smart funding, right? I didn't put the names in, but I threw the logos on. We went, in our cases, for our typical pre-A round, the one right before Series A, you focus on high net worth individuals who are domain experts from your sector, right? So you're looking at family offices, founding families from FedEx, right? C-suites from ConAgra, from Northrop Grumman, from HDR, right? Regional managers from Schlumberger, executives from Texas Instruments and from Harris, right? Early stage investors and founders in Tesla, and Adaptive Insights and Workdays, right? And all the way to Berkshire Hathaway companies and James Hardie in the building material side. So you've got a very diverse group of people, but the one thing that's there is they understand your sector that you're in, industrial AI. They've all been operators before at companies. If they're from these financial groups, they've worked in industrial banking for a long, long time. So they're focused on the sector you're in, and they can all open doors and provide input. And in many cases, these are some of the smartest folks for applied AI in the world who've been doing applied AI for government agencies for over 3 decades. So we look at it and say, go bring you the most. If you're pre-A, bring in the best angels you can who can help you get to the next stage and the next stage. And of course, they get the best terms for that. VC's leaders versus VC lemmings, right? The smart money, right? Whether it's AI or not, really ain't as smart as you think it is, right? Most VCs, as we said before, have never scaled a company. They've never built a company. They've never founded a company. Never worked for a company. They're financial folks, right? And that's why they're running portfolios. So AI, from a technical point of view, or industrial or operations AI, or just operations in general, really understand that sector. So you got to look at those GPs and say, do they know what I'm doing? And are they going to be able to help me beyond just a capital source? And this really comes down to what I call the double 80-20 rule. About 20% of the funds in the US, particularly in Silicon Valley, produce 80% of the returns, right? Really, it's going towards 90-10 now. That's a rule of thumb. The next one is within that fund that's producing 80% of the returns, only about 20% of their GPs are actually producing the best deals. They're producing 80% of the returns for that specific vintage fund. So you really have about 4 to 5% of the GPs, the general partners in Silicon Valley and in New York and in Dallas, Fort Worth, and Austin, that produce 90+% of the returns for the entire industry. In the LPs, the limited partners know that. They actually track the individual GPs between funds and as they jump to new funds or start their own funds. So what you get is the lemming effect, right? The check the box effect, the pattern matching, as they call it, where most VCs who don't really know a sector well or aren't taking chances are just following the leaders, the best performers over time into a sector, because so-and-so is into IoT, or so-and-so is into drones, or so-and-so is into AI, or data science workbenches, or advanced analytics, or whatever it is, Bitcoin. And everyone needs to have that box checked because they want to be one of the top 4 or 5 companies that gets an exit, knowing that most of their deals are going to flop. So if you look at it in the right corner there, right, you think of VCs, everyone talks about 10x. Well, when you pull out the 2 and 20 over 10 years, the VCs that actually return on a net IRR basis, 3x back to their LPs is 5% of the VCs. Think of that. Only 5% produce 3x. So this is a diversified portfolio. LPs, it's a small percentage of alternative investments, right? For those that produce 2 to 3x return, that's about 10% of the VCs, right? 1 to 2%, 1 to 2x return, 35%. So a full half of the VCs in America right now do not beat the S&P 500 on any given 10-year basis, which means that it would have been smarter just to put your money in an index fund. For those who can pick them well and can get in, right? Hey, you can get into a later stage Sequoia deal, that's money. If you can get into a later stage XYZ fund, that can help you. But most VCs aren't beating the S&P, and that's the dirty little secret. So the person sitting across from you think is a genius, and they're smart. Don't get me wrong. They went to a great school. They got an MBA. They've got a lot of funds. But it doesn't mean they're smarter than you, and most of them are not better stock pickers. let alone company pickers. So just focus on those 4 to 5%, focus on the people, the GPs who know your sector and that you have a good rapport with. And remember, we talk about diversity. Well, here's some numbers here, right? The reality is, for the 27 years I've been in business, Silicon Valley, 90% of mostly white male VCs finance over 90% mostly male white founding companies. And that's the way it's been up until the last few years. There's been a big push for diversity. I'd say it's coming slower. You go to other parts of the country, it may be better. New York has a much better percentile basis in general, a much more diverse, large city, obviously. But just to kind of take that to the opposite, if you look at the last numbers I have for 2017, of the $85 billion raised in 2017 in the US, only 2.2% went to women of color or minority women. So that's a big juxtaposition when you think about that, right? In some cases, if you're a minority or if you're a female, the cards are stacked against you. There's a lot more funds out there now that are more diverse. A lot of funds that got slapped on the hand or went through scandals have made big changes. The LPs have forced them to make changes. So seek out people that might appeal more, realizing though that LPs are still, and GPs are still just trying to make money. Last things I'll say on this slide, because it's important, it's a thick one, is for that 3x net IRR, so the best 5% of the VCs out there producing 3x the money for their LPs over 10 years, right? The average best you're going to get is one home run, right? One or two medium deals that are worth talking about at a cocktail party, a couple losers that are kind of okay, small deals, a little up, a little down, and then half of them are complete write-offs. Not a little, but completely tanked. Went under, no equity ever sold, no acqui-hire. That's the best case scenario. And if you translate that to someone like an Andreessen Horowitz, right? A16Z, Mark Andreessen, created browser, Netscape, absolute genius, created LoudCloud, started A16 with Ben Horowitz. Even look at their portfolio there in the left corner, right? Their first fund was a top quartile, not decile, but top quartile. This is from a quartile rating. Their second, third, and fourth funds weren't, right? Their fifth was, their sixth wasn't, their seven was, and on and on and on. So even the smartest VCs have a hard time getting that performance over and over again, right? Things tend to revert to the mean over time. And if you look at that first fund, take it apart and peel back the onion, what's the deal that made them most of the deal that made them most of the money, returned most of the money? It was the second coming of Skype. It wasn't the first time people invested in Skype when it came out to Scandinavia. It was the second time when they reinvested in it, repackaged it, and then sold it to Microsoft. So any PE firm or investment bank could have done that. Look at Kleiner Perkins, again, one of the older firms in the Valley, and it's the same thing. So again, just realize that these people are smart, but they're not necessarily smarter than you, and they're focused on fund performance over time. And even the smartest people like Mark don't have perfect records. Most of their funds, after 5 or 6 years, when you can actually start tracking them in earnest, don't beat the S&P 500. They're in the second, third, or fourth. They're in the half quartile, third and fourth quartile, or just the second quartile. So lots of times, if you meet some of these average VCs, check the boxers, you've got to, we call it simplifying it. Some folks will call it dumb it down. We've done things like this in the past. This is an old slide, but you'll hear people talk about the Uber of X, the Google of Y, the Facebook of Z, the Airbnb of A. We said things like, hey, Salesforce have sales reps have Salesforce, engineers have GitHub, merchants have Stripes, operations people have had nothing. But now operations people working on end-to-end supply chains have throughput, right? These are the kind of things you'll do in your deck to try to simplify it. And you'll try to take the message and say, hey, if industrial bottlenecks are endemic across the whole economy, and they are by definition anything that reduces productivity, forget all of these different KPIs you hear about. What you care about is that companies are hindered in their ability to increase their uptime, reduce their costs, and expand their output. And that's what we're here for, right? So you'll try different messaging with different VCs and see what sticks. Because again, AI is tough. Industrial AI, which you'll see more of again in Texas and the Midwest and the Southern Belt, is really hard. So a lot of us turn to CVCs, corporate VCs, in their related innovation labs. And the good thing is that corporate VCs, when they work well, they rarely lead deals. They usually follow on, but they fund and nurture companies that align with their near and long-term portfolio holes, with their operation needs, with their long-term objectives, with their strategic vision. So I've raised a lot of money from CVCs in the past. They're great sources, and they can't guarantee it, but usually a deal comes in with one or more of their business units over time. Otherwise, why would they be investing in you, right? They're often the ones that are successful are the most boring investments that are out there. Why? Because they align to a strategic goal of some large multinational manufacturing or warehousing conglomerate. Not very sexy stuff per se, right? This is an Amazon with flying drones. But you have to realize a lot of the CVCs, there's over 300 out there now in the US, they chase hot deals too. And the reason is, they want that access to deal flow. They want to hang out at the right cocktail parties with the right VCs. And ultimately, it's job hopping. It's their stepping stone, if they do things right, to get into a VC job with 2 and 20 as a GP, which is, again, let's call it the good life, the easy life. You own Park Place. Still hard work. So there's the fear of missing out, right, on those type of trends. That it's a stepping stone to a 2 and 20 type of VC job. And, there's been very few corporate VCs, less than 20% that last every time there's a VC downturn. So some of the bigger names from the last 4 have been, Intel, Cisco, Qualcomm, Salesforce is in there really well right now. Some you've heard, a lot of ones built around family insurance or meat packing or whatever, where you just go, there's really no fit. And when hard times hit, what's the quickest thing you could cut? CVCs, the innovation labs, because they don't actually do anything short-term towards your production, your bottom line. So just realize that when you talk to CVCs, some of them are chasing hot deals. Some of them are actually looking after the best interest of the second group is who you want to go after, because they bring smart money, they bring patient money usually. And if you can align it with the holding company, you could usually get additional corporate, commercial deals done that way. So we'll take it back to this kind of we're an AI startup, we're an industrial startup, we're solving some of the biggest problems out there. So you would think that the funding's there, right? But if you look at the last 20 years, and if you look at this last quarter as representative of that, right? If you look at industrials, it's about 2% of all the $100 billion of funding in the US last year and this year. If you look at energy and utilities as another, for Texas as another proxy, same thing. It's about 2 to 3%. So kind of a little bit of a letdown, right? But it comes down to people again, right? This is a people business. And so it's like schoolyard bro investing. VCs are people. People play on the schoolyard with who they know. They have their clicks and they invest in what they understand, right? It's take it back to school. If I can't explain my math homework, you're not going to get it and I'm not going to get it. If I'm a partner who can't explain your business, right, to my other partners, when I socialize it and eventually get it to the investment committee or the partner meeting, then, it's never going to happen. So part of your thing is to break this down and simplify it so that they can pitch their own GPs and have enough people vote on your deal at that partner meeting, right? That's why VCs hire junior people, associates, analysts, to do the hard work, to make the phone calls, to figure out a new sector, because most of these people didn't come from that sector. They don't know oil and gas, they don't know industrial, they don't know warehousing, they know finance, they know how to run a portfolio. And so you get a lot of kids trying to get smart. And most of the calls you get from associates will be that. They're doing competitive intelligence. So again, focus on your meetings on the GPs, the general partners, or the MPs, the managing partners, because they're the only ones who sit on the investment committee with voting power, or the partner meetings. Anyone else is just another person you have to get to. They could be helpful, but often they're just trying to get information from you. And think about it, right? It's a game of follow the leader. Most of the 90% of VCs, 95% who don't produce the most returns are following the smart kids, right? They're copying from their homework. They're pattern matching is the big term here from the cool kids. What is so-and-so doing in robotics? What is so-and-so doing in electric vehicles? And ultimately VCs will tell you, we need to find conviction. Finding conviction just means that you've checked the box enough on all of the basics that they could allow their emotions to overcome their reason. That's all it is, right? Okay, you've got a good team. Okay, you got good financials. You got good founders. You got good product market fit. You've got metrics that are taking off. I can't see a reason not to invest. I'm really excited about what you're talking to, because you made it into a simple value proposition that even I could understand it and I could explain it to my partners and they get it and we can vote on it. If you can't do that, they're not going to find conviction. They're going to keep kicking you. Hey, this is cool. Let's stay in touch. Hey, this is interesting. Let's stay in touch. Hey, it's not a really good time right now. When you get to $1 million IRR, give us a call. When you get to $1.5 million IRR, give us a call. Or sorry, ARR. And know the 10 questions you want to ask to every VC. Right? Are they the right stage? Right? Do they have over 50% dry powder to spend, or are they just reinvesting on existing deals? Right? Are they in a competitive deal? Is this the right GP or MDP you're talking to, the right partner to begin with? Right? Who can make the decision? What does their past performance look like? Is there a good chemistry between you and them? Because you're going to have hard times, and it's a long-term marriage, right? You're taking someone to the prom short-term. You think, hey, this is really exciting, but long-term, you're going to be married for 5 to 10 years. So make sure you want to work with those people. So if you look at the 2 to 3% here, where VC funds go in industrial energy, and you look at it here, AI, where is the biggest impact to business and society going to come on a value-added basis? Number one by far is manufacturing. It's 2% for VCs, right? Wholesale, distribution, and retail, right? That's the third, right? You look at logistics being in the top 10 too. You look at utilities and energy, they're there too. So you've got industrial is huge part of the economy, the $90 trillion GDP. It's making some of the biggest contributions in the case of manufacturing, the biggest contribution to society and to businesses. And yet it has the smallest amount of investing. So what that tells me, as an 8 times founder and someone who's done industrial AI now for 4 times, is there's a mismatch. At some point, people are going to figure out that market, and we need to get in now and get capital now before 1,000 other companies jump in. You also look at it and you say, hey, there's 1.8 petabytes of data currently on the shop floor being produced from old money. So if the money's there, and you have all these legacy systems, how come you're not using them? Why you're pitching me on industrial IoT and Industry 4.0 and everything else going on? So we look at it and we also say, hey, make sure you know who you're selling to, right? Silicon Valley sells to IT people. Folks in the Midwest are going to sell to operations people, right? OT is where 70% of the IT budget lays, operations tech. So know who your audience is, know who you're pitching to, realize that a lot of Silicon Valley companies don't have the knowledge that you're going to have here because they've never been there before, right? They've been on the IT path. Understand hype waves, know what Amara's law is, that people tend to overestimate technology in the short term and underestimate it in the long term. That plays out in the Gartner hype cycle. Huge explosion where there's returns. Then there's too many companies rush in with too much funding. There's not enough revenue dollars. You go through a trough of disillusionment and eventually get to the path of productivity, which is a couple winners and some other folks. So don't underestimate that time horizon. A few companies get out. Most companies will fail in every sector. And the creative destruction of Jupiter cycles gets faster and more compressed every year. Understand that most of the waste is sitting in your company, and that financial cost accounting, which is where the VCs and public companies lie, is very different than your operational accounting of how you're putting product, putting services through your pipeline. Those are very different. And then, of course, talk about your founders. I won't talk about us. This is just an example deck. Talk about your existing advisors and investors, where they came from, chairman of Deutsche Telekom, CIOs of Volkswagen, applied AI experts going back to 1983, right, which most people don't have, supply chain experts, 6-time CFOs, things like that. Show these kind of slides, obviously, because people want to know that you have access, you have smart people behind you, you have people who are investing behind you and opening doors, which ultimately makes your sales cycle faster. And watch out for the hype funds, the Java funds, the social media funds, the Google Glass funds, right? The I fund. These are all flash in the pans, right? You see these all the times. You're going to have these type of flows because you got to simplify it. We take data, we throw it through an engine, we show you different things, and these are the problems you solve. You're going to have your different version of that. They may be simpler than this, but everyone has to have it. The dollars to data problem you're solving using existing data to solve bottlenecks and free up working capital. And just pay attention. A lot of the best signs you get are right on the ground. They're with traffic, they're with stores. We've all seen it during the pandemic, obviously, but I've had a lot of them here for 20 plus years in Silicon Valley, right? Highway 101 on the peninsula tells me where the economic cycle is based on traffic. The 280 tells me where the funding cycle is. And the 880 on the other side of the Bay Area tells me where the industrial, manufacturing, and transportation cycles are. So just by watching those, you get a feeling for where you are in the economic cycle. There's more Ivy Leaguers going to Silicon Valley than Wall Street. It's another sign that you're at the top of the market, right? Who's building the biggest, shiniest new headquarters? will often 3 out of 4 times tell you who's going to fail in the next 1 or 2 years from a stock point of view, right? There's more Teslas in the commuter lane than there are commuters. That's another test, right? And rents and on and on. I've got about 25 or 30 of these, but they tend to give you a good gist of what's going on and if you need to raise capital sooner or if you have time to raise it later. Realizing every good raise takes 3 to 6 months, no matter how good you are. You'll talk about your company. You're going to talk about the different things you do. If you're HIPAA certified, throw it in there. If you're a minority small business, female-owned business, a federal contractor, you name it, let them know. Any advantage you have, any partnership you have, walk them through your solutions, walk them through the awards you have, the partnerships you have, that you're a preferred solution, that you're a startup of the year, that you're a preferred partner of the year. Get it out there. This is your chance to brag. If you're localizing in other countries, because supply chains are global and Ford and GM may be in Detroit, but they send you to factories in Mexico and Turkey and Germany and Poland. Show them you have localized versions, that you have it in multiple languages, and that you have partners around the world. And then, of course, brag about your PR, right? This isn't even the logos yet. I haven't even gotten to this. This is just from the last 4 months of this year. And this will eventually make it to logos, and just show them that you're getting press, you're winning awards, you're speaking at events, right? These are things that people care about ultimately. If you go through everything we just talked about, and I'll get to QA in 5 seconds, really the 4 biggest take homes for AI, and particularly if you're raising outside of Silicon Valley, is if it's anything about AI or operations or industrial, you're going to know more about your industry, most likely, than the VC sitting across from you. Doesn't mean you have to belittle them per se, but it does mean to take power in that and help explain to them and help make them smarter. Because they're just going to be doing pattern matching, and they're going to compare you to everyone else who's better funded in front of you. Second thing is, VCs have seen dozens of companies like you, regardless, that you've never heard about. So make sure you know who they are, and if you don't, make sure you know how you differentiate yourself to the 20th power than everyone else. The third thing is realize ownership is the most important, right? It's not vanity valuations. It's not unicorn status. It's what percentage do you and your founders and your early investors own over time as you dilute down and down with every given round. You typically lose control between Series A, between Series B and C, but you shouldn't at Series A. So don't give up that much equity early on. And last, realizing raising capital is a system. It's tenacious. There's no guarantees. It's 4 to 6 months of work almost every time. I've only once in my entire career had a term sheet come from the very first pitch and that we took. And that was not the best performing company, right? It's actually the ones that took the longest time to raise capital, the ones that turned out to have the best returns on average. So be tenacious, realize it's a marriage. It's a long-term capital marriage. And you may be able to get it there locally in Austin or Dallas, Fort Worth. You may have to go up to Utah. You may have to go to Silicon Valley 10 or 15 times. And you will probably talk to 50 to 100 VCs that you've already pre-qualified before you get 4 to 5 term sheets. And that's it. That's my email. I'll try to ask a couple questions if you have time, or you can kick me off. And I'm seeing some nice comments. I'm trying to see if there's any questions here.
Hey, Seth. Yeah, definitely the numbers that you were putting out there were super interesting. It doesn't look like anyone has any questions. So with that being said, I'll definitely give you some of your time back. And then thank you for coming and speaking at Dallas Startup Week and supporting, like the Dallas startup ecosystem. Oh, we have a question from Bill.
Yeah. I'm seeing one. Amber, I do have an essential slides list. Amber, I put together. If you email me at this email on the, I can send it to you. It's just a collaboration of 5 or 6 other ones, having done a lot of decks. Oh, sorry, Bill, you keep moving too fast. Yeah, so deploying capital outside the Bay Area. Sorry, glasses need to get to a doctor. What you typically see is VCs will invest within about 100 miles plus or minus of where they have a home office or an office, right? So if you have a New York office, a Boston office, a Silicon Valley office, that's where about rule of thumb, again, rule of thumb, 80% of your capital is going to go. About 15 to 20% of deals they will deploy elsewhere. And so that really means, unfortunately, that unless you have a vibrant ecosystem locally as you get into the VC rounds, you're probably going to have to make the trek out to Silicon Valley, Sand Hill Road in San Francisco, University Avenue, out to New York City. There's probably at least 15 to 20 decent VCs there out of 80, 90 names, and some in Boston, particularly if you're in medical tech and medical devices, and a few others. The good news during COVID, if there is any, is that most VCs are taking calls or doing video Zooms, and about half of those have already done deals over a Zoom call. That number might have gone up. That was last month's number. So deals are getting done still, particularly for newer VCs that have a new fund with a lot of capital to deploy. They've got to put capital to work, right? They can take their time and look for the right deal, but they will take a Zoom meeting, and you don't have to fly out there anymore, which makes it a lot. It kind of levels the playing field for those of us, and I've lived in the middle of the country before for a decade, and I know what it's like having to fly back and forth to Silicon Valley. If you can avoid that, it lets you really focus on keeping your business going, and it makes capital raising a little bit easier. But your money most likely will include someone from one of the large capital centers. Brad has a question. How much should founders plan to give up in a pre-seed raise for a pre-revenue startup to get to an MVP stage? That's a great question, Brad. So you can actually go and look, and there's quite a few VCs that talk about that on Medium and on Twitter. But in general, you've kind of got your early seed, your kind of called bootstrap capital. I call it your seed stage, your angel stage, and your A. Different people have slightly different names for it. VCs for the Series A, so you kind of want to see where do I want to go and how do I work backward. So the Series A being the first priced round, typically, they're going to want between 18 and 25%. If you're good, you usually settle on around 20%, 1/5 of your company. And these markets might be 22, 25. And so if you work backwards from that on a safe or on a convertible preferred, if you're going to say, if I don't have an MVP yet, right? And people are really investing in me and my small team and our idea. So it's really hard. So what you typically want to do is do a safe. You can get safes right off the Cooley or off the United States venture capital site, venture capital US. And a safe note is just basically an option that says you have a right to buy under these certain terms. Usually it's a discount, 10, 15, 20%, with 15, 20% being the norm. And often there's a cap in there. And the cap helps protect really early stage investors where you might say, hey, I'm going to put a 4 million cap or a 6 million or a 7 million cap, so that no matter what happens when that A round happens, let's say it's 20 million post money, you got in at a 20% discount at a round that was capped at 7 million. And that gives them the protection without you having to fight about valuation and how much equity you're going to give up. But realize every time you stack on one of those safes, when those convert over, that's going to be more dilution to you. So you're going to have your cap table, you're going to include your safes separately on a different tab, bundle those together, and then show on a fully diluted basis what ownership is, what the options are for the employees on a fully diluted basis. And then if all of the safe note holders with their caps or their uncapped notes, what they convert to as well, at any given valuation. But in general, you really don't want to give away, if you think about it, if you control 50% and 75, you don't want to give away more than, for the first 2 rounds, 15 to 20% of the company, right? If you can do it that way. Would you recommend crowdfunding for the situation above? Crowdfunding works really well for physical products, things that you can deliver. So when you're building something, if someone gets something tangible afterwards, that's where I've done industrial IoT companies, smart locks, the biggest in the world, and things like that, consumer devices, where you say, hey, if you put in X, Y, or Z money now, not only you're funding something that you think is cool, but you're going to be the first person to get it when it gets done. The rule of thumb used to be that crowdfunding, typically about 80% of the products that you funded never actually made it to market in the first 12 months. They were usually delayed. Even some of the, if you think about Unikey and Kivo Smart Lock, the biggest in the world, when August Lock came along, which is very well funded out of Silicon Valley, I mean, they almost came 2 years late to market, right? But they did come to market and they got funded very well after that. So crowdfunding is good if it's physical or it's tangible. If it's industrial AI software, that's really hard to get people to do that unless you have an excellent network, in which case go for it. Okay. Says she's a certified coach who works with many clients who are system engineers and have a technical skill set. What would your guidance be to those in the operation space trying to become more involved with startups, VCs, either in a consulting capacity or as an employee? Are there any particular ideas? Yeah, I mean, I kind of had to skip through it, but you have to remember, Silicon Valley is IT, right? It's information technology. That's 95% of the valley. So they don't get operations, right? They don't get industrial. They don't get warehousing. Most of them have never worked on those kind of companies before, unless it's been specifically in supply chain software or something like that. So as an operations person, the best thing you have to offer is your domain expertise, right? Particularly if it's in a certain vertical. If you are, in logistics or distribution or rail or oil and gas, I guarantee you there are at least a dozen, probably 3 dozen funded companies out there that are looking for people, whether it's the sales side, the marketing side, the technical side, or what have you. And they're looking for people who can speak the language and speak the vernacular of folks in that space. Because let's get real, most Silicon Valley startups don't hop on a plane in normal pre-COVID times and walk the floor, right? Walk a distribution center, walk the factory with a hard hat on. They aren't out there on oil field sites until they get really well funded, because that's not the world they come from. So that's your advantage, is saying, hey, I know this space, I know this domain, I can give you the operational expertise, I can give you the lingo, I can introduce you to the right people. And if you're into UI and UX, user interface, user experience in particular, I can help you manage how people actually use these tools on the shop floor versus what you think they do, right? Because a lot of times people are working with interfaces that are 15, 20, 30, I've even seen 40 and 50-year-old interfaces from really, really old systems. I've seen factory manufacturing facilities using 65-year-old equipment to produce the same product, right? They've automated stuff on either side, but the actual factory has changed almost none. And people are walking around manually reading, the temperature gauges, the pressure gauges, and writing them down every hour, walking up to the control tower, writing it on a blackboard or a whiteboard, and then someone once an hour types in those numbers in an Excel spreadsheet and pushes it to an Access database. So people forget 85% of companies don't use data lakes. They're not in the cloud. They're not using advanced analytics or even basic Tableau or Power BI. There's a lot of room left in the industrial or the operational world to bring best practices and to bring just tools in place. So I think that's your advantage, Melanie, is that you speak that language, and you can bridge that gap between OT operations and IT tech, right? An AI person, freshly banked, or a data scientist where there was no degree 10 years ago, they don't come out knowing which algorithms work best for automotive or oil and gas, right? There's hundreds or thousands of open source algorithms that need to be hyperparameter tuned. How do you start if I don't know your domain? It's going to take me a year as a newly baked data scientist to even understand the basics of your domain, let alone how to play with millions or billions of rows of data that you're collecting. So, domain expertise, companies are finding out, is worth a lot more than they thought it was, right? If actually, to say one more thing, the former CEO, founder of one of the founders of Home Depot, I forget his name, he was just in the Wall Street Journal the other day saying, hey, the worst mistake my successor made after I left in cutting costs and doing the old-fashioned way, he just did an across-the-board riff and got rid of as many full-time people as possible to put in the cheap part-timers. But people went to Home Depot because they had those old guys and gals who knew what they were talking about, who knew what type of joint you needed for a certain type of plumbing pipe, right? Who knew what type of adhesive you needed for a certain type of job. And so if you get rid of that domain knowledge and it's not institutionalized, it walks out the door. So again, you've got domain knowledge, use it. I hope that helps. Thank you, Molly, and everyone else. Yeah, Home Depot, man. And there was a couple years there. It was painful to go back in there. But they got some good people back again. You'll also see, Amber, too, is, and I've seen this in my family, people who get forced retirement out of whatever they're in, sheriffs, you name it. They get brought back as part-timers because they have the domain knowledge and they need it. And they actually hire them back part-time or sometimes even full-time as consultants. So you'll see lots of times people leave the company and come back better paid later on, or with a more flexible schedule, which with the grain of America, as more seniors leave the workforce, but need retirement, is going to be an option, right? Using those folks who have domain expertise, but want the flexible schedules and the remote work from home. I think that trend is going to be very interesting for kind of the 55 to 75-year-old range. People who are still very productive and very smart, know what they're talking about, but don't want a 9-to-5 job.
Last couple questions before we close up the session. Awesome. Well, Seth, thank you for being here. I mean, I work at Accelerator, and some of those numbers were completely a surprise to me. So I know a lot of people have value from it.
I'd rather take a check from you right now, man.
I mean, for the people in the audience that are looking to connect with VCs, I know that we had a panel full of VCs that ended, and then all of them went to the networking portion. So if you go over there, you might get lucky, and you might get a chance to chat with one of them.
Yeah, be aggressive, be tenacious. Realize it takes a lot of conversations to get there. It's almost never one and done. And I will say one more thing. Someone tweeted a very prominent VC about, hey, Sequoia was in the Zoom deal. They made 90x. Don't you wish you were in it? And I kind of went, well, I look back at the data. Sequoia was in the Zoom deal for Series D, right? They weren't in there for Series A, Series B, or Series C. They didn't lead. They weren't there as angel investors. So if you actually looked at it, it was Matt Oko from Data Collective. It was Jerry Yang from AME Cloud, right? The co-founder of Maverin was in there. Qualcomm Ventures, surprisingly, was in there. So if you actually look at it, you had some really good angels, some random names you didn't know about, people who were at WebEx who knew the pain because he came from WebEx too. And so VCs will say that, yeah, I was in Zoom. I led Zoom. It's a Sequoia deal. Well, yeah, it's a Sequoia deal. But what I'm proud of is the people who put money in right before the A round and in the A round, because they're the ones who got a heck of a lot more than 90x from their investment. And those are the ones, if I were you, I'd be calling up right now and not Sequoia, because Sequoia is a great company with great exits, but they often aren't there in the A rounds. They tend to jump in at growth equity because they've got such a big fund now, funds, plural, that they have to put to work. And they're not writing $2, $5, $8 million checks. They're writing 20, 50, 75, $100 million checks.
Awesome. Well, thanks, Seth. I definitely don't want to take up any more of your time. And then thank you, everyone, for being here. And then we'll see you later today or tomorrow for other sessions. Yeah. Thank you.
Thank you. Thank you. And such a great job, Trevor. You're great.
Thanks.
Okay. Bye-bye, everyone.